Everyone is so wrong about this crypto bull market. What if Ethereum and Bitcoin are about to shock the entire market and rewrite the cycle? For months, traders have been stuck arguing over whether crypto will peak in 2025 like every other 4-year cycle, or if it will run into 2026. But here's what's really happening right now. Ethereum has only just begun its run, with treasuries stacking Ethereum like never before. There's more Ethereum staked than ever before, and stablecoins on Ethereum are exploding in size. We have Bitcoin ETFs pulling in billions. Solana is getting back in the mix, and yet people keep saying the top is near. One expert who disagrees with that is Wall Street veteran Tom Lee. He believes Ethereum is entering the same kind of breakout moment Bitcoin had in 2017, the setup where prices don't just rise, they multiply. And he's pointing to the same drivers we're seeing play out: institutional flows, liquidity turning higher, and demand that is nowhere near euphoria. Tom Lee believes almost every other crypto investor is wrong about how this cycle is going to play out, and it will now be Ethereum which leads the market for the rest of 2025 and beyond into 2026. In this video, we're going to break down why the crowd is misreading this bull market, why Ethereum is at the center of the biggest structural shift in crypto history, and how Bitcoin, Solana, and stablecoins all fit into the story. If Tom Lee is right, the move ahead will shock even the most optimistic crypto bulls. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's start.
What is the current value of all the ETH in the world? How big do you think it could get? Because working backwards, that's what the 5% stake in ETH, right?
Mm-hmm.
Okay, so what do you
it's
think?
about 480 billion right now of fully diluted network value.
Okay.
But
is the supply contracting or not yet?
it's actually growing about 1%.
Growing
which is
1%.
slower than Bitcoin's inflation rate.
Okay.
It's actually a third of Bitcoin's inflation rate.
Okay. How big do you think that could be?
Well, I think that there is a very high probability, I'm going to say maybe even 50%, that Ethereum's network value will flip Bitcoin's.
At today's levels, Ethereum's fully diluted network value sits around $480 billion. That number sounds large, but context matters. Investors often forget that value in crypto isn't static. It expands and contracts based on demand, staking participation, and circulating supply. Unlike Bitcoin, where the inflation schedule is rigidly halved every 4 years, Ethereum's supply dynamics have shifted since the merge. Issuance under proof of stake is already a fraction of what miners produced, and with activity on the chain, burn mechanics can push issuance negative. The result is a monetary asset that inflates at roughly 1/3 the rate of Bitcoin, with the possibility of contraction during periods of high usage. That is not a trivial point. Supply mechanics influence how assets are valued. In traditional finance, investors focus on dividends, buybacks, and interest. In crypto, supply changes function the same way. When issuance slows and demand rises, scarcity drives repricing. Ethereum's current $480 billion figure may look expensive to skeptics, but they often ignore how much structural demand is being added through stablecoins, tokenization, and staking. As trillions in digital dollars flow across its rails, Ethereum becomes the settlement layer for global finance. The more assets live on the chain, the more its value reflects not just speculation but utility. Skeptics highlight the volatility in ETH's price and the risk that scaling competition could erode its lead. Yet history shows network effects are sticky. Bitcoin dominates the store of value narrative despite dozens of copycats. Ethereum commands the programmable money narrative with an even stronger edge: liquidity, developer adoption, and entrenched applications. Competing chains may find niches, but institutions want the infrastructure with the deepest trust and the broadest user base. For them, Ethereum is the practical choice. That's why platforms like Robinhood and major stablecoin issuers deploy directly on Ethereum. Could Ethereum's network value actually surpass Bitcoin's? Many analysts once dismissed the idea, but the probability is rising. Bitcoin is currently valued above $2 trillion, supported by ETFs and its status as pristine collateral. Ethereum, by contrast, is less than a quarter of that size, yet it supports far more economic activity on-chain. If investors begin pricing Ethereum not only as a scarce asset but as productive capital, the gap narrows quickly. A 50% probability, as Tom Lee suggests, may actually be conservative given how the market is evolving. Think about the drivers. Bitcoin provides security and scarcity, but it does not produce cash flow. Ethereum offers scarcity, a burn mechanism, and a native yield from staking. That yield at around 3% functions like an income stream. Treasury models, like the one adopted by Bitmine, can turn billions in Ethereum holdings into hundreds of millions in annual revenue. If those cash flows are distributed as dividends or reinvested to accumulate more Ethereum, it creates a feedback loop similar to corporate earnings growth. Traditional investors understand that logic instantly. It makes Ethereum look less like a commodity and more like an equity with built-in expansion. Meanwhile, supply pressure adds to the bullish case. Ethereum's net issuance is already below Bitcoin's, and during periods of heavy network usage, it becomes deflationary. That means long-term holders see their share of the total supply increase simply by staking and waiting. Contrast that with Bitcoin, where supply continues to inflate until the last coin is mined more than a century from now. If investors are looking for the asset with the tighter monetary policy in the medium term, Ethereum holds the edge. Critics say Bitcoin's brand and simplicity guarantee permanent dominance. But markets care about utility as much as narrative. If trillions of stablecoins, tokenized treasuries, and financial products live on Ethereum, its value will not be theoretical, it will be embedded in global liquidity. Bitcoin will remain the base store of value, but Ethereum could command a premium for being the productive layer of the digital economy. That's why the flippening, as termed by Tom Lee, might be closer than what we think. The broader implication is that this bull market may not just lift prices, it may rewrite the hierarchy of crypto itself. If Ethereum narrows the gap with Bitcoin, investors will have to rethink allocation models, risk frameworks, and long-term strategies. For those positioned early, that shift represents opportunity on a scale the market has never priced in before.
Ethereum, number one, is where the stablecoin boom is taking place. 60% of it. So like this whole Genius Act says stablecoins are going to go from 250 billion to 4 trillion. That's an exponential demand growth for Ethereum.
They're replacing money market funds.
Correct, and it's dollarization and all that. Ethereum pays a 3% native yield if you stake it. So the 6.6 billion held of Ethereum is over $200 million in net income right now. The day we turn on staking, not only is there no debt on Bitminer, it's going to pay you $200 million a year in dividends.
And what do you do with that? Buy more Ether?
Or we might just pay it out as cash dividends.
Where does that 3% native yield come from? Is that gas fees that
yes,
users are paying to use ETH?
Well, it's called proof of stake. So Ethereum doesn't have a proof of work model where you're competing for a block reward. It's saying if you hold ETH and you agree to stake it and validate transactions, you earn the staking fee, which is 3%.
Okay.
The crypto conversation in 2025 keeps circling back to one undeniable fact. Stablecoins are exploding and Ethereum is carrying the bulk of that growth. More than 60% of all stablecoin activity runs on Ethereum, and that share is likely to increase as tokenized dollars continue to dominate digital finance. Analysts like Bessin have projected stablecoin supply to jump from $250 billion to over $4 trillion in the coming years. Why does this matter for Ethereum? Every dollar stablecoin issued on Ethereum's rails represents more demand for block space and more value anchored to the network. Unlike speculative waves of past cycles, stablecoin adoption is sticky. Merchants, financial platforms, and even governments are starting to use these digital dollars to move capital efficiently. That means Ethereum isn't just competing with other crypto projects, it's competing with legacy finance. This is why Tom Lee has emphasized Ethereum's unique position. While Bitcoin ETFs draw institutional flows as a store of value, Ethereum represents the transactional layer where trillions in tokenized dollars will live. The two narratives are complementary, not competitive, and both attract capital that wasn't present in earlier cycles. The difference is that Ethereum's stablecoin economy grows even in sideways markets, ensuring consistent demand regardless of price action. Alongside stablecoins, Ethereum's proof-of-stake system has created a second pillar of strength: native yield. At roughly 3% annually, Ethereum staking isn't a promotional gimmick or a lending program prone to collapse. It's a structural feature of the network. Holders who lock up their Ethereum to validate transactions are compensated in new issuance and fees, and that yield has already become a magnet for institutions seeking reliable cash flow in a volatile asset class. Consider Bitmine's treasury model. By holding $6.6 billion worth of Ethereum, the company is generating more than $200 million in annual income simply by staking. Unlike mining, which requires massive upfront costs in hardware and energy, staking rewards are earned with relatively little capital expenditure. The result is an asset-light, income-producing strategy that looks far more sustainable than the boom and bust dynamics of traditional crypto mining. Skeptics might question whether 3% is enough to attract large pools of capital, but compare it to the broader financial system. US Treasury yields are expected to decline as the Federal Reserve pivots toward cuts. Money market funds that drew trillions during the hiking cycle will gradually lose their appeal. In that environment, a native crypto yield backed by global demand for stablecoins and DeFi activity becomes far more attractive. Institutions don't need double-digit returns, they need predictable, sustainable ones. Ethereum's staking mechanism offers precisely that. The bullish twist here is how the yield compounds into even more demand. If treasuries and funds reinvest their staking income, they accumulate more Ethereum over time, tightening supply further. If they choose to distribute that income as dividends, they make Ethereum look even more like a traditional productive asset, blurring the line between equities and crypto. Either path reinforces the same outcome, more credibility for Ethereum as a long-term allocation. Proof of stake also addresses environmental and regulatory concerns. Unlike proof of work, which is energy-intensive and vulnerable to political pushback, staking operates with minimal resource demands. That makes it easier for institutions to justify large allocations without drawing criticism from policymakers or shareholders. What was once seen as Ethereum's weakness, moving away from the mining model, has become one of its greatest strengths. This is why so many analysts now believe the market is reading the cycle wrong. Ethereum isn't in the shadow of Bitcoin, and if stablecoins do scale into the trillions as projected, the network that carries them could see valuations that eclipse even the most optimistic forecasts. Now, let's hear more of what Tom Lee has to say.
So keep in mind that the Genius Act and then SEC's Project Crypto is the recognition that using blockchain makes Wall Street faster and more efficient. I've seen it at Bitmine because when we get the cash, the minute it touches the blockchain, it moves we have much better visibility, and it's much easier to move, to actually track the money. The wallets are all tracked. And this is like 1971, because in 1971, the dollar went off the gold standard.
Yeah.
And everyone said, I'll buy gold instead. But remember, the dollar suddenly became a fiat.
Yeah.
And Wall Street innovated because they said, now we have a dollar. Let's make sure we can move the dollars efficiently.
You need to move bars of gold to match the movement of the dollars.
Correct. So it created Wall Street, came out of that single act in 1971. So now, 2025, Project Crypto from the SEC and Genius Act is saying, Wall Street, take advantage of this new technology to make Wall Street a tech industry. But they're all choosing to do it, or the majority are choosing to do it on Ethereum. Ethereum is a smart contract platform and has what they call EVMs, Ethereum virtual machines. So you can do basically a lot of smart programs and contracts. That's where Robinhood is doing their stablecoins, the tokenized products on top of Ethereum.
In 1971, the US dollar left the gold standard. The world shifted overnight. Gold was no longer the anchor for global money, and the financial system had to innovate. Instead of moving bars of metal, Wall Street designed ways to move paper dollars quickly and at scale. That shift gave rise to derivatives, trading systems, and the modern banking industry as we know it. Today, something similar is happening again. This time, the trigger isn't a single speech from the White House, but a convergence of regulatory recognition and technological maturity. The Genius Act and the SEC's Project Crypto represent a turning point. For decades, regulators treated blockchain as a fringe experiment. Now, they acknowledge it as infrastructure that can make Wall Street faster, cheaper, and more transparent. The logic is simple. When money enters the blockchain, settlement is nearly instant, audit trails are automatic, and operational risk declines. Even large firms like Bitmine report that once cash is converted into digital tokens, visibility improves and transfers become seamless. That level of efficiency can't be ignored by institutions whose margins are defined by how quickly they can move capital. What matters here is the platform that Wall Street is actually choosing. While Bitcoin secures value, Ethereum offers the environment for tokenization, contracts, and programmable finance. The Ethereum virtual machine is the standard that allows assets to be represented, rules to be enforced, and liquidity to circulate without constant manual oversight. That is why major platforms such as Robinhood are launching stablecoins and tokenized products directly on Ethereum. The path of least resistance for financial institutions is to build where the tooling and liquidity already exist, and right now that place is Ethereum. Just as the shift away from gold forced Wall Street to become inventive, the move toward blockchain settlement forces financial firms to behave more like technology companies. The SEC is not telling institutions to speculate on coins, it is directing them to leverage blockchain for settlement, custody, and transparency. That instruction changes the nature of finance. Banks that once relied on armies of staff to reconcile trades can reduce costs by adopting smart contracts. Brokers that waited days for funds to clear can settle instantly. The competitive edge moves from scale of personnel to scale of code, and Ethereum is a network where that code already thrives. Tokenization is the obvious frontier. Government bonds, equities, and even real estate can be represented on Ethereum in ways that allow 24/7 trading and global access. Stablecoins are only the first wave. If money market funds and treasuries migrate in meaningful size, the volume passing through Ethereum will dwarf what DeFi achieved in the last cycle. Every token minted and every trade executed generates fees and requires validators, feeding back into the staking economy that rewards long-term holders. This is why Tom Lee views Ethereum as entering its own version of Bitcoin's 2017 breakout. When policy, technology, and capital align, markets don't just rally, they transform. Ethereum is not being lifted by hype, but by a structural change in how finance itself will operate. Every sign suggests that the majority of institutions are choosing Ethereum as their settlement layer. That choice secures demand far beyond the reach of retail traders or short-term speculators. For investors, the takeaway is clear. Just as the dollar's break from gold created decades of financial expansion, the regulatory embrace of blockchain points to decades of growth for Ethereum. The more Wall Street integrates it into its operations, the more Ethereum becomes indispensable. It is a setup for a sustained revaluation of what Ethereum is worth in the global economy. What about you? Do you see Ethereum and the rest of crypto as entering a new era of long-term growth, or do you think this cycle will follow the old patterns and fade out sooner than most expect? And if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway, guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.